Welcome back. About
Great to see you, Scott.
But the only person as bullish as you has been Jim Lebenthal, who came on my halftime program today and said, quote, "I made a mistake. I was too early." Have you made a mistake as well? Have you been too bullish too soon, Tom?
Well, the market's been a lot worse than I expected. We were expecting a treacherous first half, and I would say, we do have a bit of egg on our face, but we were looking for something treacherous. It's been really tough, but then again, I don't expect to be right 100% of the time either.
I understand, but why was it worse than you thought it was going to be? What happened that you didn't anticipate?
I think that this year was a year where inflation really worsened relative to market expectations. And I think the bond market got very concerned about that, and it really forced the Fed's hand. So I think in some ways, with the war and supply chain and COVID in China, it really came to a head. And I think it put equity investors in a tough spot because stocks aren't terribly expensive. But when the bond market is sort of screaming for Fed to be a bit tighter, it's tough for stocks to hold up. And I think that's what we're kind of going through now. But, I don't think that means that we should be selling equities here either.
But doesn't that tell you that the full extent of what the Fed is going to do isn't necessarily in the market, as others, including you, have argued?
Yeah, without question. I mean, look, if the Fed decides that we need to have 10 hikes this year, I don't think that's priced in, but I also don't think it's cast in stone. I don't think 50 basis points in May or even 50 in June is really going to rattle markets further. I think what's been concerning markets is they just want to have some sense of when this could end. And I think if inflation doesn't reach some sort of apex, I think that's concerning for markets. But I also don't think it's set in stone that inflation is going to continue to be a problem even in the second half. Well, I think it's still one of these where we have to kind of watch how markets react to incoming data, and even the PCE report later this week is going to be important. But I think to me the most encouraging thing to look for, or signs of encouragement, is just to look at the bond market. And if the bond market's settling down, that's when equities can start to stabilize as well.
But what does it say to you, the nature of the sell-off that we had into the close on Friday, that the Dow today was down nearly 500, and that we staged the kind of reversal that we did? Is there a signal in there? Is there comfort that you can take to investors and suggest that that's the kind of activity I look for when I'm looking for a capitulation move? How do you assess that?
Yeah, I think we're at a moment where it's not a surprise that there's a buyer strike. There's a lot of surveys out. I think the Goldman positioning data is really instructive because institutional investors are essentially at 0 percentile exposure to equities. And so you have a buyer strike. You might have margin calls. It's not a great setup to see selling Thursday and Friday. And I think people were thinking today would be a big washout day and liquidation. And we had that in the morning and we reversed. I think one of the keys that we're watching, though, is, at the front end of this has been big cap tech, the FANG trade. They rolled over really, actually much of them struggled since mid last year, down over 25%. And this is 25% of the market. So they've gotten so beat up that they almost look like, I think that there's a good chance that Facebook becomes part of the value index in the rebalance.
Interesting.